Thank you, Claire, and thank you very much, Minister, for those words, and also Hamish for those words as well. It's a big achievement as we kind of look forward to next year. Now, I need a clicker, as it turns out. So, but while I'm doing that, just kind of welcome everyone to Outlook 2026. So we're really excited to be here excellent. Thanks, Maximo. We'll introduce Maximo in a moment. Welcome to Outlook 2026. Again, we're really excited to be back here. We're also in a hybrid format, so big thanks to the Episode 3 guys for keeping that going. And as we've just heard, agriculture at the moment is truly at a high point, hitting the industry's goal of $100 billion 4 years early. But as we look to next year, we're starting to see the emergence of climate and also market pressures that we'll hear about over the next couple of days, which are set to test the sector once again. And we think that this provides a point to reset, rethink, and also chart the next path to regrowth. And so today I wanted to touch on some of those elements which we think will be important in charting that next step to regrowth. But really, to understand what that looks like, it's worth looking at where the sector currently sits in terms of overall GVP, overall exports, and also farm performance. I'm going to paint you a picture, and then we'll hopefully show the picture. So this year, agriculture, fisheries and forestry is set to reach $107 billion, which is a record for 25-26, with agriculture itself hitting that historic achievement of $101 billion. Now, we know that production volumes are also at an all-time high, with record values seen across our livestock sectors, and amazingly, our winter crop production is set to reach its second highest on record at 68.4 million tonnes. We've seen growth across our fisheries and forestry sectors, meaning that all our sectors have contributed to Australia's regions, our food security, and importantly, our overall prosperity. But as we look to next year and our first forecast for the 26-27 season, there is an expectation of increasing challenges. We've already seen some drying across parts of Southeast Australia and those other challenges the Minister's pointed to, which are going to place pressure on pasture availability, but also as we start to look to next year's winter crop. The seasonal outlook is also one of median to below median rainfall. Oh, here we go. Hopefully my words helped paint this picture. Thank you, team. And so beyond those seasonal conditions which will place that pressure on our growth base, we're also seeing macro conditions at home starting to I won't touch it. I think it's me. We're also seeing macro conditions starting to play a role. Let's go back. Is that going to work? There we go. Macro conditions are also expected to play a bit of a role, particularly in our timber and forestry sector. Will place strain on expectations of price. So with these factors combined, we're expecting that the gross value of agriculture and fisheries and forestry to fall about 6% to $101 billion, with agriculture alone set to hit $95 billion. Now, we'll have a chance later on in the next session to get into the commodity detail, and with a number of different dynamics that play across different industries. But as was mentioned, with trade playing such a critical role in determining the sector's performance, the changing dynamics we're seeing in international markets are once again going to be a focus of where we look. And particularly for beef, as we've seen a lot of changes in market access. This year, we're seeing that solid export growth. So ag, fish and forest exports have hit $85 billion, another record to support the overall record value. A large part of this performance has been underpinned by strong red meat exports, particularly to the US. Next year, though, exports are forecast to fall to about $77 billion. This is driven by a mix of things such as the impact of trade policy changes, continued fall in demand for wine, strong global grain production, which is placing a downward pressure on prices. But in contrast, for wool, we're seeing growth in demand and prices, a much welcome turnaround. Similarly, for horticulture, export volume growth is expected to continue, leading to higher overall export value. Now, the returns that we see in our international markets are a critical determinant of the prices that farmers receive, and therefore a determinant of farm incomes. Strong production conditions and strong red meat prices have driven increases in farm cash incomes and profits this year. As you can see, we saw a 24% increase in real broadacre farm cash incomes this year to 433,000, and a 35% increase in farm profits to 210,000. But next year, those dynamics I spoke about will start to weigh a little bit on farm performance. Both farm cash income and farm profits are expected to fall to 323,000 and 126,000 respectively. But despite that, they're expected to remain healthy, with profits sitting 14% above the long-term average. Now, many of these short-term uncertainties that we're talking about that are influencing farm performance and our sector right now are also expected to continue and play out over the medium term. At this time of year, we also look out over the next 5 years, and that's where we kind of talk about the medium term. And what is noticeable from our initial projection is there's an expectation, at least initially, that we'll see some production declines. After this, the future becomes quite uncertain. And if we stay on trend, agricultural GVP could hit $96 billion in today's dollar terms, with ag, fish and forestry likely to hit 102, so stay relatively steady. But the other feature of the medium term is that we expect there will be upsides to exploit, but also downsides to avoid. And thinking about how the sector will take advantage of these upsides brings me back to that conference theme. Time to reset, rethink, and start the next growth phase. And in thinking about this question, looking at agriculture's growth over time, we've seen that it's moved in phases. So what we have here is a chart that looks at aggregate production over time. And what you can see in the past is that we've had periods of growth followed by a plateau. And you can see that we've just been through one of these kind of monumental periods of growth, with the potential for a plateau to emerge given the expectations of where we're seeing next year and the medium term. So in this context, it's worth thinking about whether we can shorten or even eliminate, preferably, the next and subsequent plateaus. And in thinking about that question, what is the path to regrow, I wanted to focus on 4 pillars which we think will be important in setting the foundations to navigate this. These have a longer term focus, but in a changing world will also influence the path of growth over the medium term. They're shown on screen and they relate to productivity, the spatial squeeze, trade diversification and climate variability. And while it's not the focus of this talk, these elements also will help the sector respond to the demands to reduce emissions and contribute to the net zero transition, allowing for growth in a low carbon future. Now, starting with the first pillar of productivity. So over the last year, we've spoken a fair amount about productivity. And as an economist, I think that's a really good thing. But both within agriculture and across the economy, and we're going to continue to go into detail in this conversation tomorrow. Now, we know that productivity in the sector has lessened, with total broadacre productivity falling from a growth rate of about 2% prior to 2000 to about 0.7% afterwards. But when we look closely at the productivity statistics, as the Minister pointed out with no slides, it points to an opportunity. What we can see behind me is a productivity frontier for agriculture. Now, the top line tells us where the best performance is sitting and where the benchmark for productivity performance is, with the bottom line showing us where the industry average is tracking. So what you can see is that the productivity frontier continues to grow, but there has been a widening gap between the best performance and industry average performance. This widening gap between average and best performance suggests that there is scope for improvement. On the chart, we've turned that scope inefficiency, but what does this mean in practice and what can be done about it? The gap is being driven by different things in different industries, but we've seen a few common elements. Things like less reforms combined with factors like the headwinds of climate change, increasing prevalence of pests and disease, incremental innovation progress and adoption, lower business churn have all started to drag on productivity numbers. Reigniting our productivity growth will take efforts from industry, the innovation system and government. So regulatory reforms that ensure competition will be important, but a focused R&D effort that are on the areas that are placing a drag on productivity will both help lift that frontier and close the gap, and thus hold significant potential. And the payoffs could be large. So closing that gap, even halfway over the past 4 years, would have added the equivalent of around $1.8 billion in additional output per year to broadacre agriculture. Now moving to the second pillar, a growing spatial squeeze across the land and sea. So we've heard a lot about the increase in renewables, investments in the grid, carbon sequestration, growing pressure for conservation, and all creating this competition for land, sea and forest resources. Now, many of these are presented as trade-offs alone, You know, talking about dragging on that production potential and dragging on that productivity chart that we've seen. But there is a nuanced story across different sectors and regions, and one which we'll pick up a bit later today. But some of these present real opportunities. So, for example, land-based sequestration could lead to very significant investments in the land sector while also being able to coexist with agriculture. So our recent analysis of what it would take to sequester the 119 million tonnes that is set out in the net zero plan showed that it would take about 18 million hectares of land. And now 18 million hectares is a large number. But as you can see behind me, given differences in carbon potential and the profitability of agriculture, there's a natural incentive to spread that across the landscape. What's more, about 59% of this activity occurs in conjunction with agriculture, either due to partial conversions of farms or through methods that allow agriculture to return after a period of exclusion. Under this scenario, agriculture will still grow by 39%, but it would be about 2% or 2.8% lower than otherwise. However, sequestration markets have the potential to deliver net returns to landholders of $9 billion, much larger than the foregone agricultural production. When we look at those areas where agriculture continues by itself, like alongside sequestration, that land generates an extra $7.6 billion in carbon returns, while seeing only a reduction in agriculture of $1.1 billion. Now that's a big return to farmers and represents a real opportunity. And given the location, the additional income stream has potential to create diversification options where there are few. But the way the transition takes place will matter, and the adjustments in areas, its production shifts to traditional agriculture and between carbon will play out. But for land-based sequestration, having options in the ACCU market will be important in delivering and defining the impact on agriculture and our regional communities. For other sectors such as forestry, changes in the access to the resource base can have a greater impact. That said, we also know that native harvesting and plantations can enhance carbon sequestration, suggesting that if we can get the settings right, including the social licence, there could be a real opportunity here as well. Now for the third pillar, diversification of international markets, where we're seeing a different kind of squeeze, and then this time in relation to market access. Australia is heavily reliant on trade and international markets as a key driver of our performance. But we've seen, as we've all discussed, significant shifts in recent years with rapid changes in market access like we haven't seen for a long time. So far, our exports have been nimble and managed these shifts relatively well, moving between markets to take advantage of that shifting sands in market gaps. What has been key is that diversity in our markets. In the case of beef, the example here, looking at different measures of diversification show that exports go to a wider variety of markets than they ever did before. This also includes the dominance of our largest export market, although it's reduced a little bit in the recent years with demand from the US. But as markets become more volatile, having options is only part of the story. The other is being ready to move quickly. When we look at beef establishments, the diversification profile is more mixed. In general, at the establishment level, diversification levels are typically lower than the national average. So nationally, we send to a vast number of markets, but at the individual exporter level, we have a narrow focus. For example, for half of the top beef exporters, 50% of their exports go to just one market, and most beef exporters only export to less than 10 destinations. Similarly, there are a vast number of potential markets, but at the export level, most have a much limited set of options. For example, of the markets that require exporters to individually register, roughly 50% of exporters have access to only 10 to 20 markets, and 15% have access to less than 10. So what this data tells us is that narratives around the national diversification may obscure an exporter-level fragility. And for Australia to remain agile, particularly for individual regions, the diversification push that's focused on actionable options should extend also to the exporters themselves. Now, the fourth pillar relates to dealing with the pressures of climate change and climate variability. We know that climate changes have impacted farm profits since 2000, knocking off around 18% from farm profits, or around $28,500 annually. When we look to 2050, while there is significant amounts of uncertainty, the certainty that does exist is that there will be more change. We see a clear finding that temperatures will increase across the landscape But for rainfall, and importantly winter rainfall in southeast Australia, there's more uncertainty. The adaptation pressure is only going to grow, and it will vary across industries, but is expected to be most acute in northern beef and western cropping regions. While for others, the most recent period since 2000, could be a fairly good indicator of what the future looks like. But we do know that the variability in swinging from wet to dry has only been increasing. So for the future, better anticipation of oncoming droughts and climate pressures will need additional help to help with preparation, but importantly to manage the transition out of things like drought. An example of the types of early warning systems that we think will be really important in this context is our Australian agricultural drought indicators. These indicators present a forward look at what's coming down the road and the impact of seasonal conditions on farm profits. So what I've shown here is a recent example. So coming into 23-24, we'll all likely remember, we were shifting out of good conditions, but there was uncertainty around what that shift would look like. The chart on the left shows what our forecast was for the season ahead, with the chart on the right what it turned out to be. Now you can see we did pretty well, and it's a bit of a game of spot the difference. For those who want to know more, we do have a booth outside, down that side, which you can dive deeper and actually have a play with the tool and see what it looks like. But the key point that I want to get across is that this tool provides an early look of what's coming down the road. And while one indicator itself won't solve all the problems, it's about increasing the information available to farmers and translating that into variables that matter, in this case, farm profits. Now with that, I wanted to end and come back to the theme of the talk. So with recent success and challenges ahead, it's timely to think about those factors that will shift the sector back into the growth gear. Reigniting productivity, managing the spatial squeeze, diversifying trading options and managing variability while adapting to a changing climate are all going to be key. We also need to be mindful of the wider international context, something that we'll go into detail in our next talk. But over the next 2 days, we'll explore all these issues in more detail. And so I hope it sparks ideas, conversation, and importantly, connection. And as always, if you want to know more, jump on our website or speak to one of our staff over the next couple of days.